Hello, and welcome to Mastering Finance with Dean Tellone. I'm your host, Dean Tellone. In today's episode 8, we're diving into mortgage lending insights, what you need to know before you borrow. Whether you're a first-time home buyer looking to refinance, a real estate investor, a business owner, or a high net worth individual considering a loan, this episode will give you clear, jargon-free insights on mortgages. We'll cover the basics of loan types, interest rates, credit scores, and the borrowing process. We'll also compare fixed rate versus adjustable rate mortgages and government-backed versus conventional loans, share real-world examples of mortgage trends, highlight common mistakes and how to avoid them, and provide a handy checklist of steps to take before you apply. Let's get started. Introduction: setting the stage. Mortgages can seem complex, but understanding the key principles will empower you to make smart borrowing decisions. In today's climate, with interest rates having seen historic lows and rapid rises in recent years, it's more important than ever to be informed before taking on a home loan. In this episode, we're breaking down the mortgage process into simple terms. We'll talk about what kinds of loans are out there, how interest rates and your credit score come into play, and what the borrowing process actually looks like from start to finish. We'll also compare some popular options, like fixed rate versus adjustable rate mortgages, and government-backed versus conventional loans, so you know the pros and cons of each. Plus, I'll share some real industry examples, like how mortgage trends shifted between 2021 and 2023, and why some borrowers chose adjustable rates when others went fixed. And stick around for the actionable insights segment. I've got a checklist of steps to prepare you for a mortgage application, and we'll go over common mistakes people make so you can avoid those pitfalls. By the end of this episode, you should feel more confident about navigating the mortgage landscape, whether you're buying your first home or your fifth, refinancing, or investing in property. Mortgage basics and key comparisons, loan types and mortgage options, conventional versus government-backed. Let's start with the types of mortgage loans available. At a high level, there are conventional loans and government-backed loans. Conventional loans. These are the standard mortgages offered by private lenders, banks, credit unions, mortgage companies, without direct government insurance. Conventional loans typically require a higher credit score. Most lenders prefer a FICO score of around 620 or above, and a stable income. If you can put 20% down, you avoid private mortgage insurance, PMI, which is an extra monthly fee, but many conventional loans allow down payments as low as 3 to 5% for qualified buyers. Keep in mind, if you put less than 20% down, you'll pay PMI until you build enough equity. Conventional loans also have loan limits, around $726,200 in many areas for a single-family home in 2023, higher in expensive markets. And if you need to borrow above that, you'd look at a jumbo loan, which often requires an even stronger credit profile and larger down payment. Government-backed loans. These are mortgages insured or guaranteed by government agencies, making them easier to qualify for if you have a smaller down payment or lower credit score. The big three are FHA, VA, and USDA loans. FHA loans, Federal Housing Administration, are popular with first-time buyers. They allow down payments as low as 3.5% if your credit score is at least 580, and even scores down to 500 might qualify with 10% down. FHA loans tend to have more flexible credit requirements. Average FHA borrowers' credit scores are often in the high 600s and can offer competitive interest rates because the government insures the lender against default. The trade-off: FHA loans require mortgage insurance premium, MIP, payments, both an upfront fee and monthly premiums, regardless of your down payment amount, and the monthly MIP typically lasts the life of the loan if you put less than 10% down. VA loans, Department of Veterans Affairs, are available to eligible military service members and veterans. VA loans require no down payment in most cases and no PMI. Plus, they often have very competitive interest rates and flexible credit underwriting. They do, however, charge a one-time VA funding fee, which can be financed into the loan. If you serve or have served in the military, a VA loan is an incredible benefit. USDA loans, U.S. Department of Agriculture, are designed for rural and some suburban homebuyers. Like VA loans, USDA loans can require no down payment. They have income limits. You can't make too high an income and still qualify. And the property must be in an eligible rural area. USDA loans have low interest rates, but do include a form of mortgage insurance, often lower cost than FHAs, and certain property condition requirements. Real-world insight. In competitive housing markets, sellers sometimes have preferences on the type of loan a buyer uses. For example, FHA appraisals have more stringent property condition requirements. Sellers may prefer a conventional loan offer if they worry an FHA appraisal could flag issues and slow down or derail the deal. This doesn't mean FHA loans are bad. It just means you should be aware of the dynamics. If you're going with FHA or VA USDA, make sure your agent communicates the strength of your offer in other ways. Interest rates 101. Fixed rate versus adjustable rate mortgages, ARM. One of the biggest decisions in mortgage shopping is whether to choose a fixed interest rate or an adjustable interest rate. Let's break down the difference. Fixed rate mortgages, FRM. As the name suggests, a fixed rate mortgage carries the same interest rate for the entire life of the loan. Common fixed terms are 30-year, most popular, 15-year, or sometimes 20-year or 10-year. If you lock in a fixed rate at, say, 5%, that rate and your monthly principal and interest payment won't change for 30 years, though your total payment could fluctuate slightly if property taxes or insurance change. The benefit of a fixed rate is stability and predictability. You know exactly what your mortgage payment will be every month, which can be great for budgeting. If interest rates in the wider market go up over time, you're protected because your rate is fixed. On the flip side, if rates go down significantly, your fixed rate could end up higher than the market, but you could potentially refinance to a lower rate in that case. Generally, fixed rate loans might start with a slightly higher rate than an introductory adjustable rate, but you're paying for the peace of mind that it won't change. Adjustable rate mortgages, ARMs. An adjustable rate mortgage has an interest rate that can adjust over time. Typically, an ARM will start with a fixed period for a set number of years, then adjust periodically. For example, a 5/1 ARM might have a fixed rate for the first 5 years, then adjust once per year thereafter. During the fixed period, an ARM often offers a lower initial interest rate than a comparable 30-year fixed loan. That's the main advantage. Your starting rate and monthly payment could be significantly lower in the early years. However, once you pass the fixed period, the rate will adjust based on market conditions, usually tied to an index plus a margin. If overall interest rates have gone up, your mortgage rate and payment will increase. If rates have gone down, your rate could decrease. ARMs usually have rate caps that limit how much the rate can adjust at once, and in total, e.g., a cap of 2% per year, and maybe 5% or 6% over the life of the loan above the start rate. The risk with an ARM is uncertainty. If you're unlucky and rates skyrocket, you could face much higher payments after the adjustment. So, which is right for you? If you plan to stay in the home long term, or just prefer stable payments, a fixed rate is generally the safer choice. It's straightforward, no surprises. If you're a first-time buyer planning to settle in for many years, the 30-year fixed is a common go-to. On the other hand, if you're an investor or someone who knows you might move or refinance in a relatively short time, say within 5 to 7 years, an ARM could save you money in the interim. For example, a business owner relocating frequently, or a high net worth individual who is financially able to pay off or refinance before the rate adjusts might choose a 5 or 7 year ARM to take advantage of the lower initial rate. Real estate investors sometimes use ARMs if they plan to flip a house or sell refinance before the rate adjusts. Real-world example. In early 2022, as 30-year fixed rates jumped from around 3.5% to 5.5% within a few months, more borrowers started opting for ARMs to keep payments manageable. The share of mortgage applications that were for adjustable rate loans spiked, going from roughly 3% of loans at the start of 2022 to about 10% by May 2022. This was the highest ARM share since the 2008 financial crisis, as buyers tried to beat rising rates. So ARMs became a hot topic again when fixed rates rose. However, caution. If you take an ARM, always have a strategy. You might plan to refinance later, but if rates keep climbing or your financial situation changes, you need to afford the higher adjusted payment. ARMs can be beneficial, but they introduce an element of risk into your mortgage planning. Interest rates and the market. What affects your rate? Whether you choose fixed or adjustable, several factors influence what interest rate a lender offers you. Your credit score. This is a big one. Lenders use credit scores to gauge how likely you are to repay the loan. Higher scores typically earn lower interest rates. As of recent data, the average credit score for approved mortgages was quite high, around the mid-700s, but don't be discouraged if yours is lower. There are loan options for various credit ranges. As we discussed, FHA can work with lower scores. Generally, if you have an excellent score, 760 plus, you'll likely qualify for the best rates. If your score is moderate, say 680 to 720, your rate might be a bit higher. Tip: check your credit report and score before you apply. If there are errors or if you can pay down some debt to boost your score, do it in advance. It could save you thousands in interest. One common mistake is not checking your credit score first and being surprised by a lower score when the lender pulls it. Avoid that by being proactive. Down payment / loan to value LTV ratio. The more you put down, the less you're borrowing relative to the home's value, which often means a better rate. For example, a 20% down payment, 80% LTV, might get a slightly lower rate than a 5% down, 95% LTV, because the loan is less risky for the lender. Many lenders have rate adjustments at various down payment thresholds, 5%, 10%, 15%, 20%, etc. However, even if you can't put a lot down, you can still get good loans. Just be aware of PMI and slightly higher rates. Loan term. Shorter loans, like 15-year fixed, often have lower rates than 30-year loans. You'll pay less interest over the life of the loan with a 15-year, but your monthly payments will be higher because you're paying it off faster. It's a trade-off. Type of loan. Different programs have different rates. FHA and VA loans might have rates a bit lower than conventional in some cases, since they're government insured, but remember to factor in mortgage insurance premiums. Jumbo loans, very large loans above conventional limits, sometimes carry higher rates than conforming loans, and adjustable loans typically have lower initial rates than fixed. Market conditions, economy and Federal Reserve. This part is out of your control as a borrower, but it's good to know. Mortgage rates are influenced by the broader interest rate market. For instance, the yields on Treasury bonds, Federal Reserve policies, and inflation expectations. We saw a dramatic example of this recently. In 2021, 30-year mortgage rates hit all-time lows around 2.65% to 3%. By late 2022, with the Fed raising rates to fight inflation, mortgage rates climbed to around 7%. This swing greatly affected how much homebuyers could afford. Keep an eye on trends. If rates are historically low, it could be a great time to lock in a fixed rate or refinance. If rates are high, some buyers might wait or choose an ARM, hoping to refinance later if rates fall. But timing the market is tough. The key is to make sure the payment is affordable for you at whatever the current rates are. The mortgage borrowing process, step by step. Now, let's demystify the process of getting a mortgage. Knowing what to expect can reduce a lot of stress. Here's a rundown of typical steps in the borrowing process. Prepare your finances. Before you even talk to a lender, do a personal financial checkup. Review your credit score and fix any issues. Calculate your budget. How much house can you afford comfortably each month? And start gathering key documents. Typically, lenders will want recent pay stubs, W-2s, or tax returns, usually 2 years' worth, bank statements, identification, and other asset or debt info. If you're self-employed or a business owner, you may need profit and loss statements or business tax returns, jeffersonbank.com. Getting these documents in order ahead of time is smart. Pre-approval. This is a crucial early step. A pre-approval means a lender reviews your financial information and credit and determines how much they are willing to lend you and under what terms, approximately. They'll issue a pre-approval letter stating you qualify for up to X amount. Why get pre-approved? 2 big reasons. A, it gives you a clear price range for home shopping. And B, when you do find a home, sellers and real estate agents will take your offer more seriously. In fact, in competitive markets, an offer without a pre-approval letter might not even be considered. It's not mandatory to have one, but it's highly recommended. To get pre-approved, you'll fill out a loan application, often called a 1003 form, and the lender will do a hard credit inquiry. This might dip your score by a few points temporarily. They'll verify your income, assets, and debts based on the documents you provided. After pre-approval, you'll know roughly your interest rate and monthly payment for that loan amount, which helps define your home shopping budget. House hunting and purchase agreement. With pre-approval in hand, you go find that dream home. If you're refinancing an existing home, you obviously skip this part. Once you find a home and your offer is accepted, you'll sign a purchase agreement contract with the seller. Now the clock starts ticking on the mortgage process in earnest, because purchase contracts have a closing date by which you need to get your financing in place. Formal loan application. Even though you got pre-approved, you now update your application with the property address and details, and you might need to provide updated documents. The lender will give you a loan estimate form that outlines the terms, interest rate, projected payments, and closing costs for the loan you're applying for. This is where you lock in your interest rate. Sometimes you might have locked during pre-approval. Other times you lock during the process. Processing and underwriting. The lender's team, processors and underwriters, will now verify all the details. They'll order an appraisal of the property to ensure its value is at least what you're paying. Lenders won't lend more than a certain percentage of the home's value. That's the LTV we mentioned. They'll verify your employment, often a quick call to your employer, and maybe recheck your credit. It's critical during this phase not to make any big financial changes. One common mistake is taking on new debt or making large purchases before closing, like buying a car opening a new credit card, or even spending a lot on furniture on credit. This can alter your debt-to-income ratio or credit score and potentially derail your approval. So, hold off on any new credit items until after you've closed on the home. The underwriter may come back with questions or conditions. For example, please explain this large deposit in your bank account, or we need an updated pay stub, or pay off this credit card, etc. Respond quickly to keep things moving. Approval and closing disclosure. Once underwriting is satisfied that you meet all requirements, you'll get a clear to close, meaning the loan is fully approved. A few days before closing, at least 3 days by law in the U.S., you'll receive a closing disclosure document, which is like a finalized loan estimate. It outlines your final closing costs, loan terms, and the exact cash you need to close. Review it carefully, make sure it matches what you expected, and ask questions if anything is off. Closing day, this is the finish line. On closing day, you'll meet with a notary or closing agent and sign a stack of documents, the mortgage, also called the deed of trust in some states, the promissory note, and various affidavits and declarations. Make sure you bring your ID and whatever certified funds are needed. Often you wire the down payment and closing cost money to the title escrow company beforehand. Once all papers are signed and the money is transferred, the mortgage is complete. You get the keys to your new home if it's a purchase. If it's a refinance, your new loan will pay off the old loan. Congratulations, you're now officially in debt. Haha, finance joke. But for a hopefully very good cause, owning real estate. Government-backed versus conventional. Which to choose? We touched on the differences earlier, but let's compare government-backed loans versus conventional loans in practical terms. Down payment. Government loans like FHA allow very low down payments, 3.5% down with credit 580 plus. VA and USDA can be 0% down. Conventional loans can go as low as 3% for first-time buyers or 5% for others, but a larger down payment, 10 to 20%, is ideal to avoid mortgage insurance. If you have a lot of cash saved, conventional might appeal so you can skip insurance. If you're short on cash, FHA/VA/USDA provide a path to home ownership sooner. Credit score and debt to income. Conventional loans usually require a higher credit score, 620 minimum, but realistically 660 plus for better rates and 740 plus for best rates. They also have stricter debt to income, DTI ratio limits, often around 45% max, though some approvals go up to 50%. FHA loans are more forgiving on credit. You might get approved with a score in the 600 range or even high 500s, and sometimes allow higher DTI, up to 50% or even a bit more in some cases. VA loans are quite flexible too with DTI, and VA doesn't have a formal credit score cutoff, though lenders impose their own, often around 620. USDA usually requires around 640 plus credit and has DTI limits as well. Mortgage insurance. Conventional loans require PMI if you put less than 20% down, but PMI can eventually be removed. When you reach 20% equity by payoff or home appreciation, you can request cancellation. It must be removed by 22% equity by law. FHA loans require their version of insurance, MIP. If you put 10% down on FHA, the MIP lasts the life of the loan. The only way to remove it is to refinance into a conventional loan later. If you put greater than or equal to 10% down on FHA, the MIP will drop off after 11 years. VA loans have no ongoing mortgage insurance, one of their best features, and USDA loans have a small monthly fee that acts similarly to MI. So, if avoiding long-term mortgage insurance is a goal and you have decent credit, A conventional loan with at least 20% down or planning to get 20% equity soon is attractive. If you can't avoid it, factor the insurance cost into your comparisons. Interest rates. FHA and VA loans often have slightly lower interest rates than comparable conventional loans, especially for borrowers with lower credit scores. The government backing kind of levels the playing field on rates. However, when you add the mortgage insurance premiums, the overall cost might be higher. Conventional rates heavily depend on credit score tiers. Top-tier borrowers often get the best conventional rates. For jumbo loans, very large loan amounts, rates and terms vary by lender. Some portfolio lenders offer competitive jumbo rates to high net worth clients, for instance, but they might require large cash reserves or other conditions. Property and appraisal. Government loans sometimes have additional property requirements. We mentioned FHA appraisals having stricter guidelines, safety and habitability issues, peeling lead paint, loose handrails, etc. may need fixing before loan approval. VA appraisals have a minimum property requirements checklist too, basically ensuring the home is safe, sound, and sanitary. USDA requires the home to be in a rural qualified area. Conventional loans are a bit more straightforward on appraisals. Basically, does it meet value and are there major condition problems? If not, it's usually fine. Which to choose? It really depends on your financial profile and needs. If you have a strong credit score and decent down payment, a conventional loan might save you money long term. No upfront fees like FHA's upfront MIP, and easier to drop insurance later. If your credit or down payment is a challenge, FHA is a great tool to become a homeowner with less hurdles. VA loans are unbeatable if you qualify. I often advise any veteran or active duty service member, check your VA eligibility first because the terms are hard to beat. No down payment, no PMI, good rates. For those buying in rural areas, USDA can be a fantastic zero down option as well. It's worth shopping around and even getting quotes for multiple loan types if you qualify for more than one. A good lender can help you compare the monthly payments and upfront costs of, say, FHA versus conventional to see which looks better in your case. And remember, you're not locked in forever. Many people refinance their loans down the road. For example, you might start with an FHA loan to get in the house with 3.5% down, then after a few years of payments and maybe home price appreciation, you refinance into a conventional loan to remove the mortgage insurance. Or someone might take a fixed rate now, but if rates drop in a couple of years, refinance to that lower rate. Just keep an eye on closing costs when refinancing. It should be worth the savings. Real-world mortgage trends and examples. To make this more concrete, let's look at a couple of real-world scenarios and trends. The 2020 to 2021 refi boom. In 2020 and 2021, mortgage rates hit record lows, around 2.7 to 3% for 30-year fixed, and even lower for 15-year. This led to a surge in refinancing activity. Homeowners who bought years earlier at higher rates were suddenly refinancing to cut their interest costs. First-time buyers also rushed in, as low rates meant they could afford more house for the same payment. For example, a $300,000 loan at 3% has roughly the same monthly payment as a $250,000 loan at 5%. So low rates significantly boosted purchasing power. This was a golden window. One could get a fixed rate under 3% and keep it for 30 years. Many high net worth individuals with jumbo mortgages also refinanced to lock in low rates, saving tens of thousands in interest. If you were lucky enough to buy or refi in that period, you likely have a terrific rate. The 2022 to 2023 rate jump, fast forward to late 2022, interest rates climbed rapidly. topping out around 7% for 30-year fixed. This cooled the housing market. Fewer people refinanced, because why swap a 3% loan for a 7% loan? And buyers had to recalibrate their budgets. This is when we saw more adjustable rate mortgages being taken, as mentioned, to try to mitigate the high rates. It's a reminder that the market can change quickly. As a borrower, you can't control the macro rates, but you can choose the loan product that best fits the current environment. In high rate times, maybe you consider an ARM or buying points, paying extra upfront to lower your rate. In low rate times, fixed loans and refinancing make a lot of sense. First-time buyer versus investor decisions. Let's say Alice is a first-time home buyer with a moderate income and okay credit. She has saved 5% for a down payment. Alice might compare an FHA loan versus a 5% down conventional loan. If her credit score is, for instance, 650, FHA will likely offer a better rate and easier approval than conventional, which may charge a higher rate for that score, or potentially not approve at all at 5% down. Alice might go with FHA to get a comfortable payment. Now consider Bob, a real estate investor buying a rental property. Government-backed loans like FHA VA are generally only for primary residences, you living in the home. So Bob will use a conventional loan. If Bob plans to only keep the property for a few years, he might even take an ARM to maximize cash flow initially. He'll also be mindful of the rent covering the mortgage, including a cushion for maintenance and vacancies. Something to keep in mind if you're an investor. The mortgage is just one part of rental property expenses. Refinancer. Example. Carol bought her home 10 years ago at a 5% rate. In 2021, she saw rates at 3%. She decided to refinance, which not only lowered her monthly payment by, say, $200, but also allowed her to cash out some equity for a home renovation. Cash out refinance means you take a loan for more than you owe and get the difference in cash. Useful if you need to fund projects or consolidate other debt, though the interest rate on cash out might be a touch higher. Carol's decision to refi in a low-rate environment was savvy. On the other hand, Dave bought in 2021 with a 3% rate. By 2023, rates are approximately 6 to 7%, so refinancing doesn't make sense for him unless he's doing a cash out and accepts the higher rate. Dave's decision might be to just sit tight with his great fixed rate. This illustrates how timing and goals matter. High net worth jumbo. Scenario. Elaine is a high net worth individual buying a $2 million home. Her loan amount is $1.5 million, a jumbo loan, since it's above conforming limits. Jumbo loans often require 20%, which she has, and excellent credit. Elaine's banker offers her a 30-year fixed at 6.5% or a 7/1 ARM at 5.8%. If Elaine knows she might relocate in 5 to 7 years for work, she might choose the ARM to save on interest. Because she's financially solid, she's comfortable with the plan to refinance or pay off if needed. High net worth borrowers sometimes also have access to portfolio loans or special rate discounts through private banking relationships. But the fundamental trade-offs of fixed versus adjustable and conventional versus jumbo still apply. Throughout these examples, the key thread is decision-making based on personal circumstances and market conditions. There's no one-size-fits-all answer. The best mortgage is the one that fits your needs and risk tolerance. Actionable insights. Checklist before you apply. Now it's time for some actionable insights. If you're considering borrowing for a home or refinancing, here's a checklist of steps to take before you apply for a mortgage and some tips to improve your experience. 1. Check and improve your credit. Obtain your credit report and FICO score. Do this a few months before you plan to apply. Why? If you find errors, maybe an old collection that's not yours or something still showing as unpaid that actually is paid, you have time to dispute and fix it. Pay down high credit card balances if you can. Lowering your credit utilization can boost your score in a matter of weeks. Avoid late payments like the plague. A single late payment can drop your score. Many people overlook their credit until the last minute, a common mistake, only to find their score isn't as high as they thought. Don't let that be you. Aim for the highest score possible before applying, as it directly affects your interest rate and approval chances. 2. Save for down payment and closing costs. Determine how much you can and want to put down. Remember, there are loans with low down payments, but you'll need at least some cash for earnest money, an appraisal, home inspection, and closing costs. A good rule of thumb, have at least 5 to 7% of the purchase price saved, even if you're doing a 3% or 5% down loan, because closing costs, fees, title insurance, escrow, etc. can be 2 to 5% of the price, depending on your area. If you're looking to avoid PMI, try to get to that 20% down. Also, reserve funds. Many lenders like to see that you'll have some money left after closing as a cushion. High net worth individuals might not worry about this, but first-time buyers should avoid draining every penny. Owning a home comes with surprise expenses, so having some savings post-closing is important. 3. Get pre-approved by a lender. Shop around for a lender or two. You can talk to your bank, a mortgage broker, or use online lenders. Compare interest rate quotes and closing cost estimates. Pro tip, all mortgage credit inquiries within a 45-day window count as one inquiry for scoring purposes, so don't be afraid to get multiple quotes. Just do them in a relatively short span to be safe within a couple of weeks. Once you choose a lender, go through the pre-approval process, as discussed in the core content. This not only prepares you for house hunting, but also ensures you fix any last-minute issues. It's much better to discover during pre-approval that, say, your income documentation is insufficient for the loan size you want, than to find that out after you're in contract on a house. So get that pre-approval done. Budget beyond the mortgage. When the lender says you're approved for X purchase price, that doesn't always mean you should spend that maximum. Do your own budget. Factor in not just the mortgage payment, principal plus interest, but also property taxes, homeowner's insurance, and possibly HOA dues, if applicable. Those can add a few $100s or more per month. Also consider maintenance and utilities, which will now be your responsibility, especially first-time buyers coming from renting. You'll find new expenses as an owner. A common mistake is overestimating what you can afford or forgetting these extra costs. As Experian's advice suggests, don't overlook the true cost of home ownership, not just the loan. You don't want to become house poor, where all your income goes to the house and you can't enjoy life or save for other goals. 5. Avoid new debts and big purchases. We can't stress this enough. From the moment you plan to apply for a mortgage until after you close, hold off on opening new credit accounts or making large purchases on credit. That new car or furniture set can wait a little. Increasing your debt can hurt your DTI ratio and credit score, possibly jeopardizing your approval. Even after you've been pre-approved, lenders often recheck credit or employment right before closing. If they see you took out an auto loan or maxed a credit card, they could deny the loan last minute. It's a nightmare scenario, but it happens. So maintain status quo in your finances during the process. No new cards, no financing new appliances, and definitely don't co-sign someone else's loan either. 6. Organize documentation. Use a checklist, like the one we're providing in this episode, to gather all the documents you'll need, typically last 2 years of tax returns and W-2s or 1099s if self-employed, last 1 to 2 months of pay stubs, last 2 to 3 months of bank statements, retirement, investment account statements, a copy of your driver's license and social security card, and if applicable, documents like divorce decrees to show alimony, child support obligations or income, or bankruptcy discharge papers if you had a past bankruptcy, etc. If you already own real estate, have your current mortgage statements and property tax bills handy, since the lender will want to account for those. Being organized can make the process much smoother and faster. If the lender asks for something, try to provide it quickly to keep your file moving. 7. Don't skip the home inspection for purchases. This is more about the home buying process, but it's related. A mortgage lender will require an appraisal, but that appraisal isn't a detailed inspection of the home's condition like a home inspection is. Always get a home inspection when you buy, so you know what you're getting into. It can save you from buying a property with major issues or give you leverage to negotiate repairs or price. Skipping the inspection to save a few $100s is a mistake. It can cost you much more in unseen problems. 8. Compare loan estimates and ask questions. When you get a loan estimate from a lender, read it. Make sure you understand the interest rate, which loan program it is, 30-year fixed, FHA, etc., and the line item estimates of closing costs. Don't hesitate to ask your loan officer to explain any fee or term you don't understand. For instance, if you see an origination charge or points, ask what it covers. If your rate is locked, confirm how long the lock lasts. Typical locks are 30 to 60 days. You want it to at least cover until your expected closing date. If you're shopping between lenders, compare the loan estimates. Look at both the interest rate and the APR, annual percentage rate, which factors in fees. This can help you decide which offer is truly more cost-effective. Shopping around for a mortgage is one way savvy borrowers save money. Don't simply go with the first quote if you have time to check a couple. 9. Plan for closing funds and moving costs. A few weeks before closing, you should know roughly how much money you need to bring to the table. Down payment plus closing costs, minus any deposit you already paid. Plan with your bank to have those funds liquid and ready. Often you will wire the money to the title company. Talk to your lender or closing agent about how that works to avoid last-minute scrambles. Also, budget for the costs of moving itself. Movers, utility deposits, any immediate repairs or purchases for the new home. It's easy to forget these in the excitement of loan approval. 10. Keep communication open. Throughout the process, maintain good communication with your lender and real estate agent. If you're buying, respond to calls or emails promptly. If something changes, say your job situation or you have a large unexpected expense, let your lender know, as honesty will help them find solutions. Everyone, lender, agent, title company, is working together to get you to closing on time. By being responsive and organized, you greatly increase the odds of a smooth mortgage experience. By following this checklist, you'll put yourself in the best position to secure a mortgage with confidence. It's all about preparation and avoiding the common pitfalls that trip up others. Remember, knowledge is power in finance. The more you know and prepare, the more stress-free the process can be. Conclusion: making informed mortgage decisions. Call to action. As we wrap up episode 8, Mortgage Lending Insights, what you need to know before you borrow. I hope you feel more equipped to tackle the mortgage process. We covered a lot of ground, from understanding different loan types and comparing fixed versus adjustable rates, to learning from real-world mortgage trends and avoiding common mistakes. Whether you're a first-time homebuyer aiming for that starter home, a homeowner looking to refinance for a better rate, an investor eyeing your next rental property, a business owner considering a commercial mortgage, or a high net worth individual navigating jumbo loans, The principles of smart borrowing remain the same. Do your homework, know your options, and make informed decisions. Key takeaways. Always consider your personal goals and financial situation when choosing a mortgage. What works for someone else might not be right for you. Take advantage of resources. Talk to reputable lenders, ask questions, maybe even consult a financial advisor if you're unsure how a mortgage fits into your bigger financial picture. And don't rush into the largest debt of your life without understanding the terms. A mortgage, when done right, can be a powerful tool to build equity and secure a home for your family or grow your investment portfolio. When done haphazardly, it can lead to stress or financial strain. So use the insights from today as a guide. Before we sign off, here's my call to action for you. If you're thinking about getting a mortgage, take the next step. Maybe that's pulling your credit report. Maybe it's calling a lender for a pre-approval discussion. Or maybe it's simply sitting down and writing out your home ownership goals. Information is great, but action is what makes things happen. And if you're not in the market for a mortgage now, chances are you will be at some point, or you know someone who is. Share this knowledge with them so they can borrow smarter too. Thank you for listening to Mastering Finance with Dean Tellone. If you enjoyed this episode, please subscribe and leave a review. It helps others find our show. In our next episode, we'll be switching gears to another important financial topic, so stay tuned for more insights to help you master your finances. Until next time, I'm Dean Tellone, encouraging you to make informed, confident mortgage decisions and take charge of your financial future. Happy house hunting and stay financially savvy.